Well, hey, good afternoon, everyone. Matt, thank you very much. Glad to be here. I appreciate your time. My name is Jason Piper. I'm Regional Director for MFS Investment Management, and I'm going to walk through some ideas today around what we call student of the market, some ideas around investing and ideas around staying fully invested through market cycles. So I know that sounds somewhat dry, but I'd like to start off by sharing a great story with you. And this story starts out with sort of with my career when I started with MFS in 2003. So I've been with the firm for about 18 years now. And MFS stands for Massachusetts Financial Services. We're a Boston-based company. And it takes a long time for them to kind of put people out in front of clients. So it took me about 6 years to get out in front of clients. And when I was finally able to do that, I was covering places like Idaho and Montana and Alaska, where I was traveling on some pretty small airplanes into some pretty remote places. So this story starts out in Kalispell, Montana. I'm ending my week in Kalispell, flying back to Phoenix, Arizona, which is where I lived at the time, and I get on a small puddle hopper airplane. So I jump on the airplane. I'm seat number one, literally the first seat on the airplane. So I sit down, get settled, and I notice that the flight attendant has the tag that says training. And now that's fine. We just want to get home. So everything is going great until it's time to close the door. So flight attendant goes to close the door, and it's actually not working. So starting to kind of wrestle with the door, trying to close it. It's not working. Metal starts clanking. I can see she's getting more and more frustrated. And finally, after about a minute of her trying to close this door, she turns around, she looks at me because I'm the only person sitting there, and she said, "Oh my, I hope that closed." So you've all probably heard that it's safer to fly than it is to drive. And I can tell you at that moment in time, that is not how I was feeling. And so I think that's a great segue into what we'll talk about today, because we've been through a lot in the last 12 to 14 months. And one of the questions that comes up is investing in the markets, is it going to help me get to where I want to be in 5 or 10 or 20 or 30 years like it used to be? Is it still a good way to help my money grow over time? And so I want to talk about that and share just a couple of thoughts on that today. Now, before I jump into the agenda and that part of the conversation, let me just take a couple minutes to tell you about MFS. We are the first mutual fund company. So we started the mutual fund in 1924 for a group of sea captains. They had a lot of money. They were gone for long periods of time, and they wanted their money to be safe and well cared for while they were gone. So the mutual fund was started in Boston as a benefit that actually was a benefit for all investors, because now the common wage earner in the U.S. who was making $5 a day was able to invest in several different companies. And as a small tangent, General Electric cost $232 a share in 1924. So investing was really, really reserved for the wealthy. Now, there's 2 points I love to share about the original story and the original fund. Number one is that of those 45 companies we invested in, General Electric, General Motors, Eastman Kodak, AT&T, of those 45, only 10 of them are no longer in business. So 35 still exist today. And the fund has never missed a dividend payment, not even through the Great Depression. And so this really points to what our philosophy is finding well-run, high-quality companies today on a global scale. And that is one of the reasons why the mutual fund is one of the most common ways for investors to access global markets today. So that's a little bit about us. We work with the advisors at BECU to help our clients and help you all get the investment outcomes and reach the hopes, goals, and dreams that you have for your money. So that's a little bit about how we partner together. So let's talk about our agenda today. We really are going to cover 3 key things. So we'll talk about the whys of investing. Why do we invest in the first place? We'll talk about putting a process in place that helps us, once we've understand that why, take advantage of what we know about the market and what we've known about the market for a very long time. And then we'll talk about staying the course and how do we stay engaged and how do we stay focused on the long term when things may not seem so good or where things may seem a little bit scary in the short term. So that really covers the bulk of what we'll talk about. And I'll go through a couple of slides. I'll go through a couple of graphs to just show you a couple ideas here. But before I do that, I want to lay out for you what we at MFS see as the biggest challenge for investors. It was true before 2020, before the pandemic. We believe it's true going forward. And it is the fact that investors' time horizons are getting longer, but their holding periods for investments are getting shorter. So what do I mean by that? If you go back to 1960 and you look at the average holding period for the New York Stock Exchange, you'll find investors held stocks for 20 or 30 years. In fact, the average holding period was 30 years in 1960. While when someone retired, it was maybe for 10 or 15 years. So oftentimes stocks were passed on to family members or inherited because the holding period was so long. Fast forward to 2021, I think it's fair to say, life's moving a lot faster today, but investment or retirement time horizons have extended significantly. Today, the average time horizon is 30 years for retirement. We have to find a way to make income for 30 years. But the average holding period in the New York Stock Exchange is less than 1 year. So when we look at that as an investment manager who's been in business for almost 100 years now, we actually see that as one of the biggest challenges for investors, but also one of the biggest opportunities for us to help our investors and share ideas on how we can make that time horizon longer and keep that investment time period longer. So that's exactly what I'll talk about today. Let me just move on to the first part of the presentation. So the fundamental question is, why do we invest? Okay. Now, if we were to open this up and have every person who's on this line answer that question, we would probably get a different answer from every single person. It's a personal decision. It has to do with your family and your career and what your hopes, goals, and dreams are for your money. So the why is actually a very personal decision, and that's what advisors help clients with. But the fundamental reason why we have to invest is because we have to preserve purchasing power over time. We have to combat inflation. Okay, so that's why we can't just put our money in a bank account and let it sit there. We have to look at other options. So I've put on the board here, or on the screen, three different commodities, more or less, that when looking at the inflation rate of these commodities over time. So on the left, you'll see gasoline, 1970, a gallon of gas cost 40 cents. In 2020, this is a national average. We definitely pay more here in Washington, as $2.17. Now, one of the things I like to do when I'm doing this presentation in person is I like to ask the audience, what's the lowest gas price you can remember? For me, that's 98 cents a gallon in my hometown of Elma, Washington, by the little gas station by the corner by my parents' house. So gas prices have certainly experienced inflation over the last, or since 1970. Take a look at milk. Surprisingly, in 1970, a gallon of milk cost $1.32. That seems like a lot. Today, $3.50. And I don't think that's taking into account things such as, organic or small batch or the things that you can find at the store that cost well over $5 a gallon. So significant inflation in things like even milk. Finally, maybe one of the most surprising is a college education. In 1970, a year of tuition was $351. Fast forward to today, well over $10,000 on average, and we know that number is skyrocketing. So as you can see, inflation is alive and well. Now, in the last 10 years, it's been a little more subdued. I'm happy to talk more about that in the Q&A part. But inflation is the number one reason why we have to preserve purchasing power. We want to make sure our dollar tomorrow buys as much as it does today. Let's look at the next slide here. Now, let's talk about the power of compounding. I'm going to take a guess that everyone here has heard of a man named Einstein. Einstein said, compound interest is the eighth wonder of the world. He or she who understands it earns it. He or she who does not pays it. And this is just a great example of what compound interest looks like, or compounding looks like. So let me just walk through, quickly describe what this is saying. there's actually there's no start or end date on this, because it's really only two things you need to think about when it comes to compounding. It's it's what your rate of return is and how much time you have. And this is why we're so adamant about extending time as much as we can, because it's in everyone's benefit as an investor. So 3 different rates of return here, starting with $1,000. And if you look at the bottom, 3% rate of return, you'll notice that $1,000 over 40 years turns into 3,000, a little over 3,000, 3,262. So you tripled your money over 40 years. Now, what happens when we double the rate of return? $1,000 at a 6% rate of return, you'll notice after 40 years is actually more than three times what the 3% is. So even though your return only doubled, you actually more than tripled how much money you ended with. Now, this is when it gets fun. Let's take a look at a 10% return. A 10% return over that 40-year period turns your $1,000 into $45,000. So if we compare that to the 10,000, not even double from 6% actually more than quadruples how much money you have. That's because of compounding. And over time, as we can grow and compound our money, it's one of the best ways that we know of to produce the investment outcomes that we want, especially when we're talking about things such as a retirement time horizon. So the power of compounding, here's 2 quick observations on compounding. There's the 2 variables here. One of them we can control, one of them we cannot. We really can't control the rate of return if we're investing in the markets. At least we can't guarantee it. We can control the time aspect. And that's why understanding and making decisions based on time is just so important, because we can actually manage that. Now, let's talk about the next step, which is process. Okay. So one of the observations we've made at MFS over many years of investing is that when we can have a process, we have a much better chance of sticking to it when things don't feel as good. So when the market's doing well and then the market's not doing so well, if we've got a process in place, it's a lot easier for us to stick to what we want to do if when things aren't feeling as well. That's very true for individual investors as well. So a process that we rely on for long periods of time is called the ADR process: allocate, diversify, rebalance. So once we've determined why are we investing, what's our goals, how much time do we have, how much risk do we need to take, and how much are we willing to take, we can put into place this process we call ADR: allocate, diversify, rebalance. So let me just walk through each one of these. First off, allocating just means allocating to the right mix of investments that's going to match your risk profile and your time horizon. So this is a very simplified list of the investment options that are available to you at BECU. You have there's a significant amount of investments that are available. For illustration purposes, we wanted to just make this really simple and show inflation, cash, bonds, and stocks. So I think this kind of paints the picture for back to the inflation piece and how do we outpace inflation. Well, let's take a look at a couple of the common investment options and how they've done. So this goes from 1978, and this is $1 invested through the end of 2020. So at the bottom, inflation, you can see it says a return or a 3.39% annual return. Basically suggesting inflation has been about 3.39% over that period of time. It's actually much closer to 2% today. So we've only seen inflation, really be reined in and come down quite a bit. But from 1978, there was a period of hyperinflation there. So due to compounding, that 3.39% is actually, that dollar is actually worth $4.19. Fast forward to cash. I think this is very interesting because this says here that your cash return over this period of time has been almost 4.5%. If you ever go to the bank or you look at what your savings account is paying you today, my guess is probably nothing close to that. Again, this captured the late 70s, early 80s, where interest rates were double digits. And so this is very skewed to the beginning of this time period where cash rates were much better. And as a small side note, I mentioned my hometown of Elma, Washington. Well, we would take my grandma in Elma to the bank every week. And the first thing she would do when she walked through the door is look at the CD board. And as time went on and the weeks and the years went on when we did this, she got more and more disappointed as she watched those rates drop to, from 7 to 5 to 4 to 3. And that's because when she was saving, she was getting double-digit rates on CDs. And I don't mean to be the bearer of bad news. We don't expect to see that again anytime soon. So cash, we expect that number to really only continue to go down. Now, take a look at U.S. bonds. So this is just loans. Bonds are loans, and loans to whether it be the U.S. government through a treasury, to banks for mortgages. There's a lot of different entities you can loan to. But over this period of time, U.S. bonds have actually done pretty well, about a little over a 7% return. So your $1 turned into 20. But let's take a look at stocks. So if you look at just the S&P 500, that $1 from 1978 has now turned into $130 with an average return of about 11.9%. And so you can now see why having a mix of stocks and bonds and potentially other investment options has really been a very powerful way to outpace inflation over time and preserve our purchasing power and help, and also take advantage of the compounding effect. Now, this next piece we call this the jelly bean chart. So this is about diversification, spreading out your risk. So you determine which mix of investments is right for you, and then from there we want to make sure that we've spread out our risk through different types of stocks, different types of bonds, maybe even some cash. And so what this page really shows you is it shows about 10 years of data, 10 years of history. Each column is a year, and you'll see at the top it says the year. And then they're each arranged with these different colors, which represent different asset classes of stocks, bonds, and cash. So here's what I would ask you to do is you're looking at this page. In the 2011, on the left-hand side, just pick whatever your favorite color is. If it's red, if it's blue, if it's one of the greenish tones there, just pick one and connect the dots on that color across the page. Just see how that behavior of that asset class has looked like over the last 10 years. This actually even becomes more interesting when we do this over 20 years. But what you will find is that pretty much any color you pick is going to have volatility. It's going to be up towards the top some years, and it's going to be down towards the bottom on other years. And that's a natural, kind of a natural behavior of a lot of different types of investments. But there's one that doesn't really do that, and that's the diversified portfolio. And on my screen, it's kind of a grayish, it's almost black colored, but it's kind of a grayish, really dark gray. And you'll notice it right down the middle. The diversified portfolio never hits the top. It never hits the bottom. And when you look at the average on the far right, what you'll notice is that it's right in the middle. Return is somewhere around 7%, as a contrast to large cap growth, which is something like, I believe that says 17%. And then commodities, which are negative 6%. So you can see it's really performed quite well over the last 10 years. But the diversified portfolio, all that is just an equally weighted mix of all the other colors. So by diversifying and spreading out our risk, spreading out our opportunity set, it also dampens our volatility. And that's really key. What we have seen over time is that when we can bring volatility and dampen it as much as we can, investors are much more likely to stick with their investment plan when things don't feel so good. So dampening volatility just it helps with helping us sleep better and sticking to the plan. Now, finally, allocate, diversify. Let's talk about rebalancing. Rebalancing, this is just a quick disclosure chart for you, disclosure page. Now, rebalancing is a fancy way of saying buy low and sell high, okay? Or sell high and buy low. So let me walk you through what that sounds like. Now, I'm going to assume that most people have heard the stock tip, buy low, sell high. It works every time. It's much easier said than done, however. But rebalancing gets us closer to putting that process in place in our portfolios. So you've got 4 pie charts here. I'm going to have you focus on the upper left. So the upper left says stocks were strong 2003 through 2007. We've started with a 50% stock, 50% bond portfolio, just to make this a real easy allocation to understand. And let's say from 2003 to 2007, we didn't touch that portfolio. So we started with the 50-50. We went away, didn't look at it again, reopened that the statement on that account in 2007. And what we'll notice is that now it's 62% stock and it's 38% bond. The stocks did pretty well over that period of time, so they became a bigger percentage of the portfolio by value. So let's say that in 2007 we reset that back to the original 50-50, and then we go away. We don't look at it or touch it for another couple of years. What we'll notice is that in 2009, right after this is at the low of the market in 2009. The stock piece actually became 29% of the portfolio. The bond piece became 71%. So both of those are much different allocations than we started out with. We started with a 50-50. 62-38 is actually more risk. 71 bond, 29 stock is actually quite a bit less risk. So what rebalancing does is we're going to reset that pie chart back to our original intended allocation on some kind of periodic basis. And, for our purposes, we'll just say once a year. So from 03 to 07, what we would do is we would, one time a year, we'd go back in, reset back to 50-50, which means we would sell some of that stock. We'd be buying some of the bonds. As the stocks were becoming expensive, we sell them off a little bit and we buy the asset class that's inexpensive, which is bonds. From 07 to 09, that would shift because the bonds were becoming more expensive. So we would sell off some of the bonds and we would buy some of the stock. As we do that over time, what we have now built in without having to think twice about it is a buy low, sell high process. So allocated based on risk, diversified broadly to match our risk profile, and then rebalance periodically to make sure we're maintaining that risk profile. So the question is, what's the outcome? How does this work? Let me show you. So we call this the tale of 3 investors. They all started at the same time. They all started with the same amount of money. The outcomes, however, are different. So investor number 1 chased performance. And to lay the groundwork for you, they each invested $1,000 over a 20-year period. So it was $1,000 a year over a 20-year period. Investor number 1 chased performance, which means if we go back to that jelly bean chart, whatever was at the top of the chart the year before, that's what they bought. And then they just changed it every year to buy whatever was at the top of the chart. Investor number 2 went for the rebound, which means they did exactly the opposite of investor number 1. They went to the bottom of the chart and they bought what was ever at the bottom the previous year, hoping to catch some kind of big bounce off the bottom. Investor number 3 practiced ADR. They invested in a diversified portfolio. They rebalanced it periodically. I think in this example, we do that once a year. They rebalanced it and they did that for 20 years. And what do you notice? They've got more money. I don't believe, though, that that's the only benefit here. Nobody has argued with me yet when I say more money is a good thing. But the key to this story and the key to this example is the fact that investor number 3 had a process in place that they managed to the entire time. They had a process. And so they had control of that. And we at MFS fundamentally believe that if we can have a process that we can work to, that we can manage, that we can work with whether the market's going up, down, or sideways, we have a much better chance of getting the outcome that we want. So let me just quickly recap, or I'll finish on this chart here, and then we can take some questions. This is we call this stay cool, calm, and invested. But here's really what this chart shows. Investing returns are not linear. They don't just go up in a straight line, or they don't go up by a certain amount every day over a year and over 10 years. They can be quite choppy. So this is $10,000 invested in the S&P 500, 20 years ending December 31st. So from 2000 to 2020. And it shows what happens if you miss some certain days. So fully invested, that $10,000 is worth $42,000, a little over $42,000 today. Now, over a 20-year period, let's take out the 10 best days of performance. If you miss those 10 best days, your $42,000 gets cut in more than half and is only worth $19,347. Let's say you missed the 20 best days. You can pretty much cut it in half again, down to $11,474. And if you miss the 30 best days, this is 30 days over a 20-year period. If you miss the 30 best days, your $10,000 is actually worth less. It's only worth $7,400. So you can see that, it's very tough to know which those days. We usually don't know which days those were until they've already passed us. But it's very tough to guess what are the right days to be invested and what are the right days to not. So we've heard a lot in recent times about day trading, and that was a big phenomena in the late 90s, early 2000s. It's reemerged, but the challenge is that we don't always know what the best days or the worst days are going to be, and our time horizons tend to be very long. So let me just quickly summarize what we talked about. Why do we invest? It's about outpacing inflation over long periods of time. The advisors at BECU this is what they do. They help people retire and set goals and set dreams for their money every single day. They have a very rich history of doing this, and they have access to, like I said, we only show a couple of examples of investment types, but there's a lot more that they have access to, and they can really tailor a plan fit to you. So Matt, I'll go ahead and turn it back to you and see if there's any questions. Looks like we got about 5 minutes left. Happy to take any questions that the audience may have.
Jason, thank you very much. Can you hear me okay? I know you guys were having trouble hearing me before.
Yeah, that sounds good.
Perfect, great. I'm going to pull in our room host, a partner of mine at BECU, Gloria Dixon. Gloria, do we have any questions yet? If not, I've got a couple here.
Yeah, we do. We have a question from Sarah, who wants to know, what are some key things to do when growing and managing assets in your 20s after you have the basics down? Emergency fund, rainy day fund, savings, and IRA.
I can't hear Gloria. She may be on mute.
Oh,
and if she is, let me ask a couple of questions while we're waiting for that. Jason, could you hear that? Well, in case, Jason, can you hear me? Raise your hand if you can. Maybe you can't.
Yeah.
You can hear me?
Yep.
Wonderful. All right, Jason, here's one. Lots of news about possible inflation in the market. What does that mean for investing? Do we wait? Do we wait for it to go by? Do we invest more? How does it affect us, or does it affect us at all?
Yeah. That's a great question. We're getting asked about inflation every day. It's definitely in the media, and so here's our view, at least at MFS. Here's how we see inflation playing out going forward. It's been, really, it's been almost non-existent for the last 10 years. The Fed, the government has tried to create more inflation, and we still are running at this kind of 2% rate, where historical average is somewhere closer to 3%. The thing that doesn't get talked about is the deflationary force of technology. Okay, so when everybody's got an iPhone or a smartphone, right? I've got two. When everybody's got access to global markets, you can buy whatever you want on your phone, literally by pushing a button. When you've got the advent of lots of different technologies, such as ride sharing or Airbnb type of taking up capacity it actually is deflationary. And the forces of technology today, we believe, are actually overpowering the inflation that has been trying to, really been trying to be created by the government. So we don't see inflation being a huge issue going forward. That being said, we still believe you're going to have to find other ways to grow your money besides cash, because cash is paying you basically nothing today.
Thank you very much, Jason. We are just about to the end of this, so I think I will close the session for now. I'd like to thank everyone for joining us on a warm, sunny afternoon in the Puget Sound area. We may not have been able to answer everyone's questions, and sorry we weren't able to get to it. We had some technology glitches here at the start. But if you do have a question you would like us to answer, please send it to communityrelations@becu.org. And there is a survey down below. You'll find it by scrolling to the bottom of the page. Please take a moment to give us feedback on this session. So with that, we, Jason, Gloria, and myself would like to thank you all for joining this session. And the next sessions will be starting in about 5 minutes. So thank you very much. Bye.
Thank you.
BECU makes a great effort in supporting the employees and the activities that are of importance to us.
Giving back to our community is very important to all of us here at BECU, to the point that we've created a program titled BECU Cares. And one of the greatest elements of the BECU Cares program is we give each employee 24 hours annually to give back to programs and nonprofits that matter to them. What's better than getting paid to do what you're passionate about and helping people?
The role at BCU allowed me to give back by giving me the opportunity to volunteer at Tukwila Food Bank, where I able to partner with the different people to prep for the food and then give back to all the people who need it. I remember it was on a Thursday morning, and I did not know that it was a long line for over 300 people line up to receive food from us. And able to see that, able to realize that how people needed it, give me a thought about I want to do more and more. And BCU still able to offer me to volunteer more and more. So that's what I'm really proud of.
Annual Day of Service, which happens every year, where the whole staff, the whole credit union closes for a day, and we go out to local high schools and do financial education. And it's just really cool to see coworkers kind of break out of their shell, be put in different environment, a different social environment that might be challenging or new, and then to come to work the next day and hear all about it, and everyone always has a big smile on their face.
Really enjoy the chances that I get to teach people in one way or another, and I really enjoy being able to fill in gaps of knowledge that people have. Whether it's a member and they don't know what their account can do, and I can tell them, oh, and you can do this and that with it, and there's these extra pieces, and here's how you can build your credit rating up using this at no cost to you.
So my favorite memory would be when I helped almost an 80-year-old member who had never gone to the ATM, and she was standing in the teller line wanting to make a deposit. And I asked her, what are you doing today? And she said, I'm just making a deposit. I said, I can help you with that at the ATM. She goes, I've never used that ATM and I don't want to use it. I've never used it, I'm not comfortable. I said, do you mind if I take you over there and show you how you can make that deposit? So she said, okay. So I took her to the ATM, we made the deposit, and she was like so happy. She said, you taught me something new today.
Sharing my knowledge, sharing my passion of helping people.
There is so much that we can do in order to help fulfill a need, and it really is just on trying to dig as deep as we can in order to find what those are. So that can separate us different from any other financial institution, because we're not just hitting numbers, we're fulfilling people's dreams.